You know what nobody talks about? The fact that the money sitting in your bank account right now isn't actually yours. Not really. Not when it matters most. I'm going to show you something that's happening right now, in real time, that should terrify anyone with significant savings in traditional banking institutions. And I'm not talking about some conspiracy theory. I'm talking about documented cases, legal precedents, and a system that's been quietly built over the past decade that gives banks and governments unprecedented control over your wealth. Let me start with a story that most people missed. There was a retiree in Canada, let's call him Robert, who had spent 40 years building a nest egg of about $380,000. Solid middle-class retirement savings. Nothing extravagant. He kept it in a major Canadian bank, same institution he'd used his entire adult life. Then, during a certain political protest, Robert made a small donation. $50. That's it. Within 72 hours, his entire account was frozen. No warning, no court order, no due process. He couldn't buy groceries, couldn't pay his mortgage, couldn't access a single dollar of the money he'd spent 4 decades accumulating. Now, you might be thinking that was an isolated incident, a unique political situation. But here's what should keep you up at night. The infrastructure that made that possible didn't disappear when the headlines faded. It's still there. It's been expanded. And it's being normalized across the Western banking system. The Bank for International Settlements, which is essentially the central bank for central banks, released a framework that gives member institutions the ability to implement what they call programmable money. Sounds technical and boring, right? But here's what it actually means. Money that comes with conditions. Money that can be turned off. Money that expires. Money that can only be spent on approved purchases. Money that isn't really money at all, but rather a permission slip that can be revoked at any moment. Think about that for a second. The entire concept of money is being fundamentally redesigned, and most people have no idea it's happening. Now, let's talk about what's driving this. Because understanding the why is crucial to protecting yourself. We're living through the largest debt crisis in human history. The United States alone is carrying over $34 trillion in federal debt. That number is so large it's almost meaningless to the human brain. But here's a way to think about it. If you spent $1 million every single day, it would take you over 93,000 years to spend $34 trillion, and that debt is growing by roughly $2 trillion per year. This creates an impossible situation for governments and central banks. They can't raise interest rates high enough to fight inflation without collapsing the economy under the weight of debt service. They can't cut spending because the political system won't allow it. And they can't grow their way out of it because the debt is growing faster than the economy. So what's the solution? Control. Control over capital flows. Control over savings. Control over what you can do with your own money. This is where gold and silver become absolutely critical, and I want you to understand why from a purely mechanical standpoint. Physical precious metals exist outside the banking system. They can't be frozen. They can't be programmed. They can't be inflated away with a keystroke. They're the ultimate form of financial sovereignty, which is exactly why central banks themselves are accumulating gold at the fastest pace in over 50 years. Let me give you some numbers that tell a story. In the third quarter alone, central banks added 186 tons of gold to their reserves. That's the highest quarterly purchase on record. China has been buying every single month for over 2 years straight. Poland just announced they're accelerating their accumulation program. India, Turkey, Singapore, the list goes on. These are the institutions that have access to every piece of economic data, every classified briefing, every insider conversation. And they're converting their paper reserves into physical metal as fast as they can without causing a panic. Why? Because they know what's coming. They understand that the current monetary system is reaching its mathematical endpoint. When you have negative real interest rates, meaning inflation is higher than what you earn on savings, you're essentially being taxed for holding currency. Your purchasing power is being systematically destroyed. The only question is, how fast? Now, here's where this gets personal for anyone with significant retirement savings. The average American has the bulk of their wealth in 3 places: their home, their retirement accounts, and their bank accounts. 2 of those 3 are completely vulnerable to the exact scenario I'm describing. Your bank account can be frozen, restricted, or subjected to bail-in provisions that were quietly legalized after the financial crisis. Your retirement accounts are trapped in a system of custodians, brokers, and regulations that can change overnight. But there's a mechanism that most people don't know exists. It's called a gold IRA, and it allows you to hold physical precious metals inside a tax-advantaged retirement account. If you're sitting on $100,000 or more in traditional retirement savings, this is something you need to understand. I put together a comprehensive guide that breaks down exactly how this works, the tax implications, the custodian requirements, all of it. It's completely free, and you'll find it in the description below. No obligation, just information that could be crucial for protecting your retirement. The reason I'm bringing this up now is because of timing. We're at a unique moment where you can still move assets without restrictions. But that window is closing. We've already seen capital controls implemented in Greece, Cyprus, Argentina, Lebanon, and dozens of other countries. The pattern is always the same. Everything is fine until suddenly it's not, and by the time people realize they need to act, it's too late. Let me tell you about what happened in Cyprus back in 2013, because it's a perfect case study of how fast things can change. Cyprus was a modern European country, part of the EU, with a banking system that was considered safe and stable. Then, over a single weekend, the government announced that all bank accounts over 100,000 euros would be subject to a bail-in. That's a polite term for confiscation. People who had their life savings in Cypriot banks lost up to 60% of everything above that threshold. No warning, no vote, no recourse. The justification was that it was necessary to save the banking system. And here's the terrifying part. This wasn't some rogue action by a desperate government. It was approved and encouraged by the European Central Bank and the International Monetary Fund. It became the template for how future banking crises would be handled. The term they use is burden sharing, which means that depositors, people like you and me, are now considered part of the capital structure of the bank. We're not customers anymore. We're unsecured creditors. This is why the smart money, the people who understand how the system actually works, are moving assets into forms that can't be touched by these mechanisms. Physical gold and silver are the most obvious choices, but it goes beyond that. It's about diversification across jurisdictions, across asset classes, and across systems of control. Now let's talk about what's happening in the gold market itself, because there's a supply-demand dynamic developing that's unlike anything we've seen before. On the supply side, global gold production has been essentially flat for the past 5 years. The easy gold has been mined. New discoveries are rare. The ore grades are declining, meaning miners have to process more rock to get the same amount of gold. And the permitting and development timeline for new mines is stretching into decades in many jurisdictions. Meanwhile, demand is exploding. We've already talked about central bank buying, but that's just one piece. Exchange-traded funds backed by physical gold have seen massive inflows. Retail demand in Asia is at record levels. Industrial demand for gold in electronics and technology continues to grow. And now, we're seeing a new category of buyer. Institutions and high-net-worth individuals who are treating gold as a monetary asset, not just a commodity. This creates a mathematical problem. When supply is fixed and demand is rising, price has to adjust. But here's where it gets interesting. The gold market has been suppressed for years through paper derivatives. The COMEX futures market trades hundreds of times more gold on paper than actually exists in physical form. This has allowed banks and institutions to cap the price by selling unlimited paper contracts. But that system is breaking down. We're seeing unprecedented stress in the physical market. Premiums for physical gold over the paper price have widened dramatically. Delivery times are extending. Refineries are running at full capacity and still can't keep up with demand. The Shanghai Gold Exchange, which deals in physical metal only, is consistently trading at a premium to London and New York, which are paper markets. This is a sign that the real price of gold, the price you have to pay to actually get metal in your hand, is significantly higher than the quoted spot price. What happens when this disconnect becomes too large to ignore? History gives us a clue. In the 1970s, there was a similar situation where the official price of gold was held artificially low through government intervention. When that system finally broke, gold went from $35 an ounce to over $800 in less than a decade. That's not a prediction. It's just historical context. But the dynamics today are remarkably similar, except the scale is much larger. Let's talk about silver for a moment, because silver might actually be the more explosive opportunity. Silver has this unique characteristic, where it's both a monetary metal and an industrial metal. It's used in solar panels, electric vehicles, electronics, medical applications, and countless other technologies. Unlike gold, most of the silver that's mined gets consumed and is never recovered. It's gone forever. The global silver market is tiny. The entire annual production of silver is worth less than what Apple makes in profit in a single quarter, but the demand is enormous and growing. The solar industry alone is projected to consume more silver in the next decade than exists in all available inventories. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure requires silver. The green energy transition that governments are mandating is fundamentally a silver-intensive transition. Now, here's the kicker. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently around 85 to 1. Historically, that ratio has averaged somewhere between 15 and 30 to 1. When you mine silver and gold from the ground, you get about 8 ounces of silver for every 1 ounce of gold. So the current ratio is completely disconnected from both historical norms and geological reality. What does this mean? It means that silver is either dramatically undervalued relative to gold, or gold is dramatically overvalued relative to silver. Given that gold is being accumulated by central banks at record pace, it's probably not overvalued, which suggests that silver has enormous catch-up potential. But here's what you need to understand about silver. It's volatile. When silver moves, it moves fast and hard. In 2011, silver went from around $18 an ounce to nearly $50 in a matter of months. Then it crashed back down just as quickly. Silver is not for the faint of heart. But for people who understand the fundamentals and can handle the volatility, the potential returns are significant. Now, I want to address something that I know some of you are thinking. This sounds like fear-mongering. Banks aren't going to freeze my account. The government isn't going to confiscate my savings. This is America, not some third-world country. And I get it. I really do. It's uncomfortable to think about these scenarios. But let me ask you this. Do you think the people in Cyprus thought their banks would confiscate their deposits? Do you think Canadians thought their government would freeze bank accounts over political donations? Do you think Americans in 1933 thought their government would make private gold ownership illegal and force citizens to turn in their gold at below-market prices? All of these things happened. They're not theoretical, they're historical facts. And the common thread in every case is that people didn't see it coming until it was too late to do anything about it. The question isn't whether these things can happen. We know they can because they have. The question is whether you're going to wait until it's obvious to everyone, at which point it's too late to act, or whether you're going to take steps now while you still have options. Here's another angle to consider: opportunity cost. Let's say I'm completely wrong about everything. Let's say the banking system is perfectly safe, governments would never restrict access to your money, and the dollar remains strong forever. What's the downside of holding some physical gold and silver? You have a tangible asset that's held value for thousands of years. You have insurance against scenarios you hope never happen. You have diversification outside the traditional financial system. But what if I'm right? What if even 10% of what I'm describing comes to pass? What's the cost of not being prepared? That's the calculation you need to make. Let me give you a framework for thinking about this. Imagine your wealth as a house. You wouldn't build a house with only one support beam, right? You'd want multiple beams, redundancy, structural integrity. The same principle applies to your financial life. You want assets in different categories, different jurisdictions, different systems. You want some assets in the banking system for liquidity and convenience. You want some assets in real estate for stability and income. You want some assets in stocks for growth potential. And you want some assets in physical precious metals for protection and sovereignty. The exact allocation depends on your situation, your risk tolerance, your time horizon. But the principle is universal. Don't put all your eggs in one basket, especially when that basket is controlled by institutions that have demonstrated they will prioritize their own survival over your financial security. Now let's talk about the practical steps. If you're convinced that holding some physical gold and silver makes sense, how do you actually do it? There are several options, each with pros and cons. The most straightforward approach is to buy physical coins or bars from a reputable dealer and store them yourself. This gives you maximum control and privacy. The downside is security and insurance concerns. If you're holding significant value in precious metals, you need a serious safe or security system. Another option is allocated storage with a private vault company. You own specific bars or coins that are segregated and identified as yours. You can visit and inspect them. You can take delivery at any time. This gives you the benefits of professional security without giving up ownership or control. For retirement accounts, as I mentioned earlier, a gold IRA allows you to hold physical metals in a tax-advantaged structure. This is particularly powerful for people who have large balances in traditional IRAs or 401ks. You can roll over funds without triggering taxes or penalties, and the metals are held by an approved custodian in an approved depository. The key in all of these approaches is to make sure you're dealing with reputable companies, you understand the fee structures, and you're actually getting physical metal, not paper certificates or unallocated storage where you're just a creditor of the storage company. Let me tell you about a mistake I see people make all the time. They get convinced that precious metals are important, so they go out and buy shares in a gold ETF or a mining stock. And look, there's nothing wrong with those investments in the right context, but they're not the same thing as physical metal. An ETF is a financial product that trades on an exchange. It can be halted. It can be restricted. It's subject to counterparty risk. Mining stocks are equity investments in companies that have operational risk, management risk, political risk. Physical metal is different. It's a tangible asset that you can hold in your hand. It has no counterparty risk. It can't go bankrupt. It can't be hacked. It can't be inflated away. That's the whole point. Now, I want to address the price question because I know this is what everyone wants to know. Where is gold going? Where is silver going? Should I wait for a pullback? Here's the honest answer. I don't know, and neither does anyone else. Anyone who tells you they know exactly where the price is going is either lying or delusional. Markets are complex systems with countless variables. Short-term price movements are essentially random noise. But here's what I do know. The fundamentals have never been stronger. The supply-demand dynamics favor higher prices. The monetary and fiscal policies of major governments are creating conditions that historically have been extremely bullish for precious metals. The geopolitical environment is increasingly unstable. The banking system is more fragile than it appears. And the smart money, the central banks and institutions with access to the best information, are accumulating physical metal as fast as they can. Does that mean prices can't go down in the short term? Of course not. Gold and silver are volatile. There will be corrections. There will be periods where it feels like you made a mistake. But if you understand why you're holding these assets, if you see them as insurance and long-term wealth preservation rather than a short-term trade, then short-term price movements become irrelevant. Let me give you a mental framework that might help. Think of precious metals like fire insurance on your house. You don't buy fire insurance because you think your house is going to burn down next week. You buy it because if your house does burn down, the consequences would be catastrophic, and the cost of the insurance is small relative to the protection it provides. You hope you never need it, but you're glad you have it. That's how you should think about gold and silver. You're not betting that the financial system will collapse. You're protecting yourself in case it does. And unlike fire insurance, which is pure expense, precious metals are assets that have historically held and increased their value over time. Here's something else to consider. The window for acquiring physical metal at reasonable prices may be closing. We're already seeing supply constraints. Mints are struggling to keep up with demand. Premiums are rising. Delivery times are extending. If we see a real crisis, a real rush into physical precious metals, you won't be able to get it at any price. The market will simply dry up. This happened in 2008 during the financial crisis. Gold and silver prices actually dropped initially as everything sold off. But you couldn't buy physical metal. Dealers were out of stock. Premiums exploded. The paper price and the physical price completely disconnected. People who waited for lower prices to buy ended up not being able to buy at all. So the question isn't whether gold is at the perfect price right now. The question is whether you want to have physical precious metals as part of your wealth protection strategy. And if the answer is yes, then the best time to acquire them is before everyone else realizes they need them. Let me bring this back to where we started, the risk of bank freezes and capital controls. This isn't some distant theoretical possibility. It's happening right now in various forms around the world. Negative interest rates in Europe and Japan, capital controls in China, banking restrictions in Lebanon and Argentina, account freezes in Canada, bail-in provisions in the EU and United States. The infrastructure for controlling your money is being built in real time. The legal frameworks are being put in place. The technology is being developed and deployed. And it's all being done quietly, without public debate, under the guise of fighting terrorism, money laundering, tax evasion, or whatever justification is convenient. But here's the thing. Once these systems are in place, once the government and banks have the ability to freeze, restrict, or confiscate your wealth with the push of a button, the temptation to use that power becomes overwhelming. Especially when governments are desperate for revenue, when debt levels are unsustainable, when the political pressure to do something becomes intense. You don't want to be in a position where your financial security depends on the restraint and good judgment of politicians and bureaucrats. You want to have assets that are outside their control, that can't be touched by their policies, that give you options no matter what happens. This is why physical gold and silver are so important. They're not just investments. They're not just inflation hedges. They're financial sovereignty. They're the ability to preserve your wealth regardless of what happens to the banking system, the currency, or the political environment. Now, I know this has been a lot of information, and I know some of it is uncomfortable to think about. But here's what I want you to take away from this. You have options. You have the ability to protect yourself. You have time to act, but that time is limited. The people who will be hurt the worst in any financial crisis are the ones who refused to see it coming, who kept all their wealth in the traditional system, who trusted that everything would be fine because it always has been. But the people who take steps now, who diversify, who hold some physical precious metals, who understand the risks and prepare accordingly, those people will not only survive but potentially thrive. The choice is yours. You can dismiss this as fear-mongering and hope for the best, or you can take practical steps to protect what you've worked your entire life to build. You can keep all your wealth in a system that has demonstrated it will freeze accounts, implement bail-ins, and prioritize institutional survival over your financial security. Or you can move some of your assets into forms that can't be touched, can't be frozen, can't be confiscated. I'm not telling you to panic. I'm not telling you to sell everything and buy gold. I'm telling you to think critically about where your wealth is, who controls it, and what could happen if the system comes under stress, and then make informed decisions based on that analysis. The window is open right now. You can still move money. You can still buy physical precious metals. You can still set up a gold IRA if that makes sense for your situation. But windows don't stay open forever, and when they close fast. Don't let the bank freeze your wealth. Don't wait until it's too late to act. Take control of your financial future while you still can.